Welcome to the Invested Dads Podcast, simplifying financial topics so that you can take action and make your financial situation better. Helping you to understand the current world of financial planning and investments, here are your hosts, Josh Robb and Austin Wilson.
All right. Hey. Welcome back to the Invested Dads Podcast, the podcast where we take you on a journey to better your financial future. I am Austin Wilson, research analyst at Hicks & Zerker Capital Management.
And I'm Josh Robb, director of wealth management at Hicks & Zerker Capital Management. Austin, how can people help us with our podcast?
We would love it if you would subscribe. If you're not subscribed, so hit that plus, follow whatever button that is on your podcast player so that you get new episodes when they drop each and every Thursday. And we'd love it if you'd visit our website and sign up for our weekly newsletter so you get notified when those episodes drop, as well as get a nice little summary and some good links to listen to it directly from there. So that's how you can help us. But we are here today to help you in determining whether or not the United States economy is in or going to be in very soon an economic recession. And
yes.
I'll say this is a follow-up to a discussion we actually had in 2022, and we'll link that episode in the show notes where we kind of talked about a similar thing, but a lot has changed since then. Mm-hmm. This is a very fluid economy we got going on.
Number at the end of the year changed.
It did. Now it's 23 instead of 2022. But we are going to be looking at the good, the bad, and the ugly in the economy today, and kind of give you some expectations on where we're at now and where we're headed.
All right. So we're mentioning recession.
Yep.
So maybe it'd be good to define a recession.
That goes into what we talked about in that other episode. Because
I know it does.
In the old days, you could say 2 negative quarters of GDP in a row, boom, recession.
Yes.
We had that. Mm-hmm. No recession was called by the NBER, National Bureau of Economic Relations.
Yep. Which is, by the way, a non-governmental agency.
However, they are the ones that are officially responsible for calling a recession. Now, they always call it well after it starts in retrospect, and they're very late on that. So that's not such a surprise, but hasn't been called yet, even though we got last year 2 negative quarters GDP. But we actually got a really, really strong fourth quarter.
Yes.
So the good parts of the economy right now. This is going into one of the major reasons why the NBER did not say we're in a recession, and it's because the labor market is the strongest it has been in our lifetimes and probably will be forever in our lifetimes.
Okay. Bold statement.
I think you're going to have more times where the labor market's worse than it is now than better, for sure, in our lifetimes.
I'm going to just wait till next month when it just ticks slightly lower, and I'll be, wrong. You said wrong. Best ever.
So here's the situation. Yes. We live in an economy where there are 11 million job openings.
Okay.
As made evident by the latest job openings and labor turnover.
Those are companies reporting they're hiring X positions.
11 million is a lot. And that is nearly double. 1.9 times actually, but nearly double the amount of people in the labor force that are actually unemployed.
Okay. So their unemployed number, that looks at, how do they factor that number?
Well, it's looking at the actual labor pool. So the people who are in the labor, quote unquote, in the labor market, determined by age and disability and all these different factors. And then the percentage of them that are unemployed looking for work. Okay. So there are roughly half as many looking for jobs that there are actual jobs available. So everyone's kind of saying, well, why doesn't everyone just go get a job because there's so many out there? Mm-hmm. Well, there's a little bit of friction between what areas of the geography those jobs are or what fields and industries those jobs are. So it's not necessarily a one-for-one. But this indicates some tightness in the labor market. Mm-hmm. There's a lot of jobs out there, and there's not a lot of people looking for them, which really puts upward pressure on wages. But this is a really strong thing that we have that we've not really experienced in a long, long, long time. Mm-hmm. And it's a very, very strong labor force. So one other factor that is key is that the unemployment rate, which as we just got as the time of this recording for the month of January.
Always looking backwards,
was 3.4%. 3.4%, which is the lowest since 1969. That's really low. And if we really get aggressive with comparisons, we just saw some of the highest we've seen in a long, long time during COVID, when we were up in the 15s, I think. This is a steep decline on that. But we've kind of been ho-humming around the 3.6 to 3.5 range for a while, and now we're down at 3.4. Yep. Really, really low. So that's really a very strong part of the economy. Labor market doing very, very well. Another strong part of the economy is retail sales. Consumers, you and me, listeners, you and me, Josh, everyone, spending money. consumers have continued to spend money well above what they were spending pre-pandemic. So we could actually, back in the day, connect a nice little trend line versus over time of consumer spending. And, there were consumer spending recessions, but they all kind of hovered around this trend line, slow and steady, up and to the right, increasing slowly over time. Since COVID happened, it dipped. It dipped in COVID. In fact,
makes sense.
In global financial crisis, it took 40 months to get back to the level of spending it was before at the peak. Well, during COVID, it did dip. It only took 5 months. Very, very quick. But since that dip, it just shot to the moon.
Yeah, people went crazy.
People went crazy spending money. And it is showing some signs of softening, but still remains vastly above that trend line from pre-COVID. What that means is that company revenue, top line, is looking very strong. And people are just spending money like crazy. Another one is wage growth. While it has not kept up with inflation over the last couple years, it has remained above historical levels because of the high inflation largely. And depending on what metric you're looking at, people are making 4 to 6% more year over year. Now, that's less than inflation, but still strong by historical standards. So
higher than it's been doing before
exactly.
that. Okay.
So pretty strong on that front as well. So that's another good thing. Another good thing is services. This is experiences, movies, going to a park.
What is a car wash? Is the automated car wash a service? And then the one where you have to get out and do yourself a goods? How's that work?
That's a great question, Josh. I do not know the difference of car washes.
The self-service versus the automated
I do
one?
know that we go to our local Bell stores for when we need a car wash in the winter.
Yep.
Because here in Ohio, they love to put salt down. And we took both vehicles this weekend to get gas because they both needed gas. And when you get car wash, you get 10 cents off a gallon.
There you go.
So that's a pretty good
Did
deal.
you ever do the math how many gallons you need to get a free car wash?
It's not free.
Yeah.
It's just it's cheaper.
It's cheaper.
So it ends up, the car wash probably ends up being like
bucks.
$4 or $5, and then you get a little bit less gas. So yes, my 5-year-old loves the car wash. Our 3-week-old doesn't even know what's going on yet. Yeah, so services going very, very strong. December 2022, so the end of the year, was actually the only month since May of 2020 where we had a negative PMI reading. So this data provider called ISMs, they provide data where it's a ratio essentially where if you have a 50 or above, that reading means that part of the economy is growing. It's an expansionary territory. And if it's below 50, it's in contractionary territory. Well, other than December 2022, which was kind of a blip, every other month, including January 23, has been expansionary. And we're back in expansionary territory at a reading of 55, strongly expansionary territory. This is actually one of the major drivers of our inflation story, but this is very strong in terms of growth. So that's another pro of what's going on, the good in the economy. And last but not least, inflation. We talk about it all the time. It's likely to have peaked.
Yep.
In fact, it would take crazy things to happen for it to go back to where it was. So last June 2022, we saw a headline CPI, Consumer Price Index, headline meaning all-encompassing of that basket of goods, reading of 9.1% increase year over year. That's a freaking crap ton of inflation. Highest we've seen in like 4 decades. Now, since that peak in June, we've had 6 months straight of cooling of year-over-year inflation increases, bringing us back to 6.5% in the latest reading that we had.
Still high, but working
its way down. And as the comparison years, if we're looking at year-over-year, we're now going to be looking at the beginning of 2023. Well, as we continue to step along, you're going to get a nice boost from the beginning being really high.
It's a higher starting point.
Yep. So that should continue to come down going forward. So those are some really good things we have going on in our economy. And looking at those things alone, you'd be like, yeah, I guess I can understand why we aren't in a recession technically at this point. However, there are some negatives, and the negatives are kind of increasing day by day right now. One of those negatives, the bad we're talking about here, manufacturing, looking at the other side of the economy as measured by
services.
ISM, services and manufacturing.
Okay.
Looking at that 50 threshold as kind of being contractionary or expansionary, same thing. So manufacturing has been under 50 for over 3 months now. So that's contractionary. And this is interesting because this is all during a time where the U.S. is talking about reshoring some production and things like that, bringing it here because there's been a lot of drama with geopolitical tensions around the world with China and
supply
Russia.
chain disruptions.
Yeah.
All
so
that fun
the
stuff.
more you can bring that in-house, so to speak, in the U.S., the better that will be over the long term. Well, manufacturing's been slowing as we're trying to do that, so that's not necessarily a good thing at all, especially when you think that a lot of the economy is employed as manufacturing associates. Another weak area of the economy is housing. So housing starts, they're down 23% from their cycle highs, which was in early 2021, and new home sales, on the other hand. So that was housing starts and then new home sales. So the sales of those new homes, those are down 38%.
Wow.
That's huge. And historically speaking, as these numbers drop this much, typically that is leading into some sort of recession. Why, you might ask, is this happening? And well, one big reason is mortgage rates.
Yep.
As interest rates across the board have gone up, mortgage rates have gone up as well. And you really were able to get a 30-year fixed rate mortgage at the beginning of 2022 for under 4%.
Yep.
At the peak, that was almost 7.
Mm-hmm.
Now it's down around 6. But that has made housing affordability really come under pressure. So there's been a lot less demand for housing in general. So that's another weak area of the economy. And then another one is layoffs have begun to occur. So the labor market is very strong. We talked about all the good news. But in certain areas, and a lot of that being retail or technology industries, and more all the time are being announced, we've seen a lot of layoffs being announced, as companies have been doing their earnings, really in an effort to save money because these companies are running into earnings pressure. So a lot of the companies that were actually doing the best and stood to gain the most during COVID, they got a little fat. They got a little aggressive with their hiring without doing it responsibly.
They saw the growth and thought that would continue at the same pace.
Yep. So they're being forced to lay people off. So that's sort of the bad parts of the economy right now. And then we have to talk about the ugly. And the ugly is really an unknown at this point. In my opinion, is the ugly is the Fed impact. So many economists believe that the Fed, when they hike rates, which we've gotten a lot to slow down the economy using monetary policy, it takes 12 to 18 months of a lag before that's really felt in the economy. Well, if we think about March 2022 as being the starting point of those interest rate hikes, starting with 25 basis points in March 2022, March 2023, coming up real quick, will be 12 months from the first hike of the tightening cycle. Then we got 7 more hikes, which included 4 75 basis point interest rate hikes in a row.
Yep.
What this means is that we've not felt the impacts, economically speaking, of what the Fed has done. The Fed has not broken anything yet from their interest rate hikes, but will all of the impact of the lagged effect of these hikes break something? We don't know, but it could be, the question is, do we run into a wall?
Yep.
So you get, maybe in March, you really start to see some slowing from the beginning of that. But by the end of the year, it just
drops off.
Yeah, by the end of the year, you're just running in mud because of all the increase of interest rates. So that's where we are. That's the ugly. The ugly is an uncertainty because it's been the second fastest tightening cycle ever from the Fed, the fastest since the early 80s. And we don't really know how the economy is going to react. We know how the markets are reacting. That wasn't so great. But the economy really has yet to feel it yet. And I think that is one of the key things looking at 2023 that we really don't know what's going to happen.
So let's take a break. We saw kind of the background of the recession possibility for this year. I'm going to give you a dad joke, and then we're going to come back and talk your thoughts and my thoughts on what is all this mean.
Yeah.
All right. So we're in winter. It's cold-ish. Yes. Some days colder than others. Do you know why bees stay in their hive during the winter?
Nope.
Because it's swarm.
Swarm
in there.
That's great. So I had a bee infestation at my house last summer and had to have some guy come and take care of him. He did a great job, took 2 treatments, but it got them all. But it was in the wall. The old TV antennas had the post things attached to the side of the wall. Well, the old owner of our house took it down but never filled the holes in. So the bees made their way into there, and it just so happened to be right in my daughter's room.
Yep.
And because I installed a bunch of ductless mini splits air conditioners in the house, there were teeny little cracks that I thought were pretty well fixed, but small enough for a bug, I guess, to get in. So we had bees getting in. That was not good for our little girl's room.
No.
So we got that fixed.
That's good. If they couldn't get in, it'd be almost like a white noise machine type of thing. Just in the background. Not super loud, just kind of a low hum. But yeah.
A low hum. I like aloha.
Yeah.
So Josh, that's a dad joke of the week. Now, we must impart our opinion.
Yes.
I'll go first.
Yes.
Here's what I think. I think it's going to be really hard for the NBER to call a recession with the labor market as strong as it is. 3.4% unemployment is no joke. 11 million job openings is no joke. That has got to weaken very quickly for them to be like, oh, well, the economy's in trouble.
Even a 1% hike is still relatively low long-term for unemployment.
And if you get laid off, the friction level to find a new job is pretty low.
Yeah.
You can find something pretty quick.
You can get some income.
Exactly. So I think that is a big thing keeping us from saying we're in a recession and we're headed to one right now. Now, I do think that the recent jobs data, so we got great jobs report came out for January where we had 500 and some thousand jobs created in the month, more than double the expectations, and that's where the 3.4% unemployment rate came in. Very, very strong. Kind of makes me think that any major economic contraction, I had originally kind of thought that it would have been happening early to mid this year. I think it's now more likely to be late this year to early next year as far as likelihood goes. And I think what that is going to be driven by is the lagged impact of the Fed. The lagged impact of the Fed, it's the wild card. We don't really know exactly how that's going to work out, but the middle of the year is going to be pretty aggressive from the economy's feeling of last year's rate impact. That's what I think is going to be happening. Again, we're not in a recession right now. We had great economic growth in the fourth quarter. We have a great job market. There's some cracks occurring, some weakening occurring. Companies' earnings are coming under pressure. Those sort of things are happening. But I think it's more likely very, very, very late this year or early next year now that we get an official recession than we do mid this year or even early this year. So what is your thoughts, Josh?
Well, you're more in tune with economic side of things than I am. But I'm going to say, just by my own experience, that it seems like lately the market reacts to not so good news positively, the stock market, because that means that the Fed may have to back off or even lower rates sooner. Right? So I'm wondering if the market will mute some of this economic data by responding positively to it, which would lessen the brunt of what people are seeing in these reports.
Right.
And in doing so, because consumer sentiment matters, right?
Oh, yeah.
Because 70% of GDP is consumer. In a sense, the stock markets go up because the data's weakening, which is what we've been seeing.
It's about the Fed. Yeah,
if you get bad data news, the market's like, oh, good, the Fed's going to let off. So bad news ends up being a positive sign for the market. If they, in a sense, they counteract as everything starts weakening because of the rising interest rates finally impacting the economy, the market responds by being positive, saying the Fed is going to back off. They may even lower rates, and they, in a sense, cushion that blow.
Right.
Because whether, same as last year, even though we had 2 negative quarters of GDP, we weren't in a recession, and people are spending like crazy still, right? Through the middle part of last year, people were indifferent to what was going on. They were just spending. And I'm wondering if the same thing will happen, not from a spending standpoint, but from a sentiment standpoint, that they're saying, hey, look, everything's weakening, but that's not news. The Fed's been saying it. Everybody's been saying it. And look, the stock market's actually doing well,
right?
And it almost cushions it to the point where when everything does play through, and maybe the Fed does have to lower rates or whatever they do, it offsets that impact to mute what could have been a harder recession or downturn. We still may have officially a downturn or a recession, but from a consumer sentiment and an overall outlook of our economy, it's muted because the piece that already's reacted to this, been priced in, is now reacting to the next phase.
Well, and that's one of the things that we need to get our minds around is how the market works. The market and the economy are two different things. So I'm speaking of what the economy is going to do.
You were talking all that.
And we saw this during COVID, really, where we saw the market bottomed well before the economy bottomed.
Yeah.
So things are just getting announced that things are looking bad, and the market's bottomed.
Yeah.
So the market may have bottomed in October of 2022, and we are looking ahead. The market's always forward-looking, looking ahead at what is actually going to happen in the economy going forward. So I think that's a really good point, is just to get our minds around the separation between market and economy, because the market's going to be pricing in what's going to happen, or what the market's thinking is going to happen well before it actually happens.
Right.
So that's interesting. So you brought up another good point. I'm going to put you on the spot.
Yes.
Josh, do we get a Fed cut in 2023?
By the end of the year? That's a good question. I'm going to say no. I think they're going to stop hiking probably this late spring, early summer. And I think they're going to do their best to hold, even when they're seeing slowdown in some of their things. They're going to say, because they're going to really, I think Powell does not want inflation to turn around.
Oh, yeah.
So he's going to take the brunt of whatever this 18-month trailing impact is going to be of what he already did and not make an adjustment until he's sure that inflation is staying down at their level of 2% PCE or whatever he's looking at. So my thought is no. Yeah. I think 2024, we're going to see something, but I don't think this year. What do you think?
I could actually agree, and I would have changed my opinion over the last handful of weeks, because before some of this recent jobs data, I would have said I think we get a cut at the very end of the year. That's what I would have said. And now, after listening to the Fed and seeing some of this super great labor market information, I think that we're a little bit further from that than I would have anticipated. So now I am thinking Fed cuts not until early 2024 is when I kind of think it'll be, which the market does not agree with.
Yeah, the market thinks
the market is pricing in at the end of the year you're going to get a Fed cut, even though the Fed continues to say no.
We're not going to do it.
Stop saying
not
that.
Doing it.
We're not going to cut rates.
Yep.
And the market says, "Oh yeah, you are."
Yeah, we know you are.
So, but there's this disconnect, and I now think it's probably going to be more like 2024 before we get that. So that is where we are. There's no right answer right now. We don't know what's going to happen. We don't know what's going to happen in the economy. We don't know what's going to happen in the markets, but we do know that having a well-diversified portfolio and sticking to a plan over the long term is going to work out for you.
That's right.
So this is a great time to trust your advisor. And if you don't have one, visit our website. You can check out the Invest With Us tab, and we'd love to talk to you about what's going on, talk to you about your situation. So check that out. And as always, thank you for being here. This is a reminder that if you had someone saying, hey, what's going on in the economy? Oh, you can share this episode with them.
That's right.
And don't forget to subscribe and leave us a review on Apple Podcasts or Spotify or whatever player you listen to. And until next Thursday, have a great week.
Talk to you later.
Bye.
Thank you for listening to the Invested Dads podcast. This episode has ended, but your journey towards a better financial future doesn't have to. Head over to theinvesteddads.com to access all the links and resources mentioned in today's show. If you enjoyed this episode and we had a positive impact on your life, leave us a review, click subscribe, and don't miss the next episode. Josh Robb and Austin Wilson work for Hicks & Zerker Capital Management. All opinions expressed by Josh, Austin, or any podcast guests are solely their own opinions and do not reflect the opinions of Hicks & Zerker Capital Management. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Hicks & Zerker Capital Management may maintain positions in the securities discussed in this podcast. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses which would reduce returns. Securities investing involves risk, including the potential for loss of principal. There is no assurance that any investment plan or strategy will be successful.